Good morning, friends, and welcome to the webinar series for your investments. My name is Brian Gongware. On behalf of McKinley Carter Wealth Services, so glad that you're able to join us today for this talk on investment strategy and smart actions to consider, what you need to know in the wake of COVID-19. It's a pleasure for us to be able to host you today. We've had an incredible response of people wanting to hear the things that we've been talking about over the past 2 weeks. Last week, we had an opportunity to talk with clients on the same type of matters that we're going to discuss today, and there was such an outpouring of support and follow-up from that is that we designed a talk today to be able to be extended to those in which we currently don't work with, but are part of the community which we want to serve and help give some insight and interpretations to what's been going on in the investment markets, the economy, and maybe some things that you, whether it be personal or your organization, might consider in light of all the things that have transpired. So we're happy to be with you today. I'm honored to have such a great response, and thank you for joining us. Today is not a solicitation for business, nor any of the performance, which should be construed as a composite. As we go through the time today, we do have an opportunity for you to ask questions. And so on the right side of the GoToWebinar controls, there is a call out button and a question mark there. You can go ahead and start submitting questions as soon as you'd like. At the end of our talk today, David McKinley and I are going to have an opportunity to take and field as many of those questions as possible with our remaining time, and look forward to having that interaction with all of you. So please feel free to use that chat and ask your questions at any time starting now. So my name is Brian Gongware. I serve as a principal and Director of Advisory Services for the firm, in addition to serving as the Chief Compliance Officer and responsible for our Western Pennsylvania presence here in Pittsburgh. I'm joined today by David McKinley, who serves as principal and president, as well as our chief investment officer for McKinley Carter. With 30 years of investment experience, we're happy to have David's insights in terms of a lot of what's been going on, as well as in addition to his work here with our firm, is that he also serves as a fiduciary trustee for the West Virginia Public Investment Funds and the $20 billion of assets that are there. And while David and I have the opportunity to talk with you today, is that it's really an outcoming of the other 35 team members that we have within our firm of McKinley Carter Wealth Services, advisors and advisor support professionals working in our 5 different locations. Today we serve clients who are in 34 different states and across 3 countries. And it's really a tribute to the team approach that we've got, that so many of the ideas and what we're going to talk about today come directly from this group. In fact, we took a look back, and there's about 500 years worth of advisory experience amongst our various team members that we're calling on. And a couple of years ago, CNBC, the news and business broadcasting media, posted and gathered what they identified as the 100 best firms in our particular industry. And we are so pleased and honored to be recognized as one of those 100 best firms by CNBC when they did that study. And it's helped us get to the point today where we work with individuals and families, also nonprofit organizations, as well as businesses with their retirement plans that they might have for their employees. And it's taken us over $1 billion in assets under management. So thank you. Today's conversation takes us into really where we're going to go from an agenda standpoint and what we'd like to address today. And so before we get into it, is that certainly we want to wish you, your family, your colleagues, your coworkers, your peers, your neighbors, health and safety during this challenging time. We know that it's been difficult for everyone, and certainly it's a high priority for us to start there. But today's talk is really the things that are of a financial issue, and so we're going to take a look at what's happened over the past 2 months in the investment markets and the economy. But you may be asking, and partly why you wanted to join today, and say, well, how has all this affected my outlook and my goals? Do I need to make any changes to the goals that we have or that we've established as an organization or as a family in a financial context? And are there any smart actions that we should be doing or considering at this particular time, given our situation and given maybe what the outlook might be going forward from here? So with that as a background and getting us started, the format that we've put together is really a question and an answer. So first, the question that goes to David as our Chief Investment Officer. David, can you summarize for us a little bit of what's happened during the past 2 months?
I would love to say it's been a quiet spring, just a kind of business as usual, but this has been the most unusual time in my entire career. I think about 30 years of experiences along the way. This is absolutely what some would call a black swan. It's hard for me to believe, if you just think back to where we would have been, say, on Valentine's Day, just a little over 2 months ago, and this was just not on the radar screen, so to speak. I'll give you an example. I've been a Kiplinger subscriber for decades, and I went back just for kicks, just to get reflecting on all the things that are happening in the COVID-19 situation, and thought about when did this become a real public issue? Clearly in March, headlines. But the reality is, you go back to February, on page 2 or 3 of these short newsletters. In January, it wasn't even on the radar screen. It's absolutely crazy, the things that have unfolded. But at the end of the day, it boiled down to a virus spreading throughout the world, countries and governments, and literally just shutting down companies all over the world. That created immense uncertainty. On the slide that we're on now, kind of outlines just a handful of headlines. One, that level of uncertainty led to historic volatility. In fact, during the month of March, we had 12 records set for one-day trades, up or down. And it was both, by the way. 12 records in the month of March, half of which were down, as you might expect. Here's one, for example, down 3,000 points in a day. That certainly triggers your emotions. But on the other side, often in the day to follow, you'll see a volatile day up. So it was literally half up, half down. It's enough to break the resolve of even the most seasoned investors. But along the way, I think we also reinforced a handful of points. One is the markets generally are an indicator of things to come. And so while the COVID implications, so to speak, are continuing to evolve, the health factors, the employment factors, economic output factors are all going to continue to evolve. We'll have headlines for months, if not years to come. But the reality, we think the worst of the market is actually behind us at this point. We'll talk a bit more about why we believe that to be the case. And the last headline I'll emphasize is extraordinary government intervention. I'm not a big government guy, but the reality is this is one of those opportunities where it clearly was important to stabilize cash flow, small businesses, individuals, and families. Immense intervention, and I think it's having the desired output, but honestly, we'll have months and years to evaluate that. Let's go to the next slide, and let's take a little deeper dive into the market outlook. I mean the market impact, what happened in the last couple of months. I'm going to focus specifically for the moment on the S&P 500 and use the period from February 19 to March 23rd. February 19 was the high in the stock market, and February 23rd, at least thus far, has been the low. A 34% decline in the course of just about a month. Again, that certainly will get your attention. 3 things that stand out to me. 1, how quickly this unfolded. 2, it's normal for emotions to affect your outlook. And 3, it reinforces the importance of advanced preparedness. Let's move on. This wasn't actually the first time we've seen things like this. I'm sure many of you have experienced it over time, at least in the history books, some of you in your own life. So we went back and identified 5 historic examples. One as early as the Great Depression, and the most recent is the Great Recession, 08 and 09. On the chart, what you're looking at here is a 5-year analysis. The first row, we'll highlight that one, is dictating essentially what was the level of decline, what was the market impact during the decline. And those declines, by the way, varied in duration from 1.5 years to 2 years to as long as 5 years. So let's keep working our way through. In the first year to follow that decline, once the decline was complete, what did the sharp recovery look like? How did the market respond? Clearly a variety of different outcomes, but the average had better than a 70% recovery. But it didn't stop at the 1 year. Then you look, well, what's the longer term output? What does it look like, say, 5 years out? So what we did is we took a look at each situation and said, what was the 5-year average for each one? And then we averaged the averages. Pleased to say that on average, it worked out to be a little better than a 23% recovery on average over the 5 years to follow each of these material declines. Let's move on to the next. Oh, I'm sorry. There was one point I wanted to make on that slide, and this is again reinforcing the importance of preparedness. Is that those periods of time, again, 2, 3, 4, as many as 5 years of declines. One of the points we're going to talk about several times during this presentation is the importance of preparedness. How do you determine your risk tolerance? How much of your portfolio should be set aside in fixed income? Keep this in mind, these time periods, and Brian will refer back to them. Let's go on the next slide. We're going to break it down a little bit differently. It's not once in a generation that we have market volatility. In fact, this is a 40-year cycle, 40-year chart, and each bar reflects 1 year. The bar reflects what was the average, the total return for the year, and the dot below the bar reflects the intra-year decline. In 30 of these 40 years, we ended up with a positive number. And that's despite the fact that the average intra-year decline was almost 14%. So volatility is not unusual. It's it's along the lines, we have to learn to live with it. And how do we prepare ourselves and our portfolios? How do we build sufficient confidence and conviction to endure those? Let's move to the next slide. With this data about how things have affected us in the past and what market volatility can often look like, how does it affect our outlook? Let's start with the fact we're humans, and we can't ignore the fact that declines like this can trigger our emotions. We can't disregard them. And we're not health professionals either, so we're not here to try to address the outlook as it relates to the spread of a virus or the recovery times. What we are going to do is talk a bit about the economic and financial outlook. How do we impact your portfolio? What kind of thinking should you have in place? The next slide, we talk a little bit about one of the many factors. I am our Chief Investment Officer, and I work with a variety of people. There's 6 of us actually that steer our investment strategy. We are, by the way, discretionary managers, and I'll talk a little bit more about what that looks like. There are many data points that we take into consideration, one of which is leading economic indicators. Factors along the lines of manufacturing activity, business and consumer confidence, interest rate spreads, a variety of things that, well, as you would imagine, give you an idea of where the economy is headed. You notice in the chart, through the end of February, data reported in the 3rd week of March, things looked pretty good. But clearly in March, we've seen a material change in that direction. But it's not the only thing we should look at. In fact, let's go a little bit deeper and let's dig into corporate earnings. Excuse me. Corporate earnings are one of the most incredibly important factors because they drive valuations. They reflect the health of a company. Is this a time to be taking risk in buying assets or to be selling them? Do we have reasonable valuations? As you can see on the chart, we actually, after a really strong 2019, we actually expected a continuation of healthy earnings throughout 20 and really into 21 even. The chart, of course, reveals some meaningful changes in those forecasts, but there is good here. There is reason for optimism, so to speak. The first quarter, a material change in earnings, a decline of 14% from the prior year. The second quarter, an even further decline. Of course, we're into that quarter now. But the beauty is when you look out to the third and the fourth quarters, improving numbers. Not a full recovery at that point, but we do actually, if we look ahead to 2021, materially improved for the years. What we did here, let's go to the next slide. So here, what we did is put together a summary of data for 4 large indices, representative of the types of investments you might include in your portfolio. The first block is the S&P 500. Think of large cap US companies, blue chip names that you're familiar with. The S&P 600, smaller companies in the United States. The EFA, think of that as developed markets around the world. Continental Europe, for example. Emerging markets, think of developing markets, Asia, Latin America. What we show here is that what do we expect the damage to look like in 2020, and what do we expect the recovery to look like in 2021? We like what we see here, and it gives us a sense of optimism and hope for our portfolios, and we can talk a little bit more about how we're actually acting with this information. One of the things that I would just say is that even in the midst of chaos and turmoil, opportunities can be found. And we're going to talk a little bit about some of the things that we're doing now. Last thing I'll point out is it's just interesting to me, the emerging markets in particular, how well they appear to be holding up in 2020 and how strong 2021 appears it will be. But it's very hopeful to see such strong numbers across the board. Let's keep rolling. So I mentioned we're discretionary managers, which means that our clients have hired us to manage their accounts on their behalf. We're given a broad range of, we'll call it guardrails. Don't take more than this risk, target these kind of returns, and we're charged with managing the assets on a day-to-day basis. What we're doing here today is giving you a little peek behind the curtain. How do we make decisions? We're managing over $1 billion. We kind of joke we have a billion reasons to take things seriously. This is our top-down look, if you will, the 7 levers that we think are important in a portfolio construction. Stock or bond allocation. Well, let me back up and say, we're using a particular strategy here, our moderate growth strategy. It's not where most of our clients are. It just happens to be the largest, the most subscribed portfolio. But we have countless portfolios because we designed strategies to meet the needs of our clients. We're just going to use the moderate growth here and in a couple of other scenarios in our conversations today to represent a portfolio. At any rate, we have these 7 key levers. So the first, stock or bond. Should be overweight stocks or underweight, domestic or international, emerging or developed, growth or value, large or small. And then on the fixed income side, bond duration and quality. Just kind of gives you a little peek behind the curtain. How are we making decisions? For the purposes of today, I share with you kind of where we are, but I think in the interest of time, I'm just going to keep moving, and we can answer any questions you might have, or don't hesitate to reach out to us afterwards. The last point I'll make is that while this is another representation of data-driven analysis, we like everybody else, remain subject to emotional responses. And those emotions can thwart our best intentions. In fact, let's dig into that just a bit. So, yeah, perfect. So cycles of fear and greed, and I prefer to refer to that as extreme optimism. They're natural and they're expected. Optimism is healthy and so is fear, but both should be held in moderation. Be willing to buy when fearful, when valuations are attractive, when there's, as Warren Buffett, I believe, is quoted as saying, when there's blood in the streets. And on the other side, be willing to sell when optimism and valuations are extreme. This is, you can kind of model it out. You can picture where you fall in various cycles. Let's go a little bit deeper into this. Let's take a look. We'll work our way through a couple of analyses. So this is kind of a glimpse. It's a busy chart. It looks like there's a lot going on, and you would imagine this is a long period of time, but the reality is this is what is called a fear and greed chart. CNN a few years ago, I can't remember exactly how long ago, put together what they call as the fear and greed index, and it's a day-to-day charting of where the average investor is. This is a period of just 3 years. You can see on a scale of 0 to 100, 100 being maximum optimism or greed, and 0 being maximum fear and negativity. Wild cycles year to year. Lots of volatility, swinging regularly from these things. It is easy to become paralyzed. You need to have the experience and confidence to take action in the extremes. I'll give you 2 quick examples, and I'll use, unfortunately, they're both on the downside. The most recent, Brian, if you'll kind of highlight the section there, we're going to talk about March 2020, and then we'll do December 2018. So March 2020, in the midst of the chaos that we experienced last month, it was a perfect time for us to be doing 2 things, and Brian will put these into context. One thing we did was around rebalancing portfolios. And the second thing was around tax loss harvesting. These are ways of making the most of a situation. The simple analogy we often use is when you're handed a bushel of lemons, let's make some lemonade. Let's do what we can to help our clients out. And it's not too late to act. And again, Brian will put these into context. Another time we had a chance to do that was in the fourth quarter of December of 18. My point in sharing this is that they're frequently happening, and you've got to be willing to act. Don't become paralyzed and stuck, so to speak. Let's go to the next chart. Being paralyzed and not being able to act, I think, is among the things that lead people to become, we'll call it, average investors. This chart is produced by Dalbar and has been for decades. This is a good example of a study that they did over roughly the last 20 years. And it's a charting of returns, 20-year returns over a period of a cycle of series of different asset classes, as well as a couple of blended portfolios. So to the far left, real estate investment trusts, far right, homes, real estate, EFA. To the furthest to the right, you can see the average return and inflation. The average investor return, I'll be specific, at roughly 1.9% for average rate of return for the last 20 years, slightly under inflation for the same period of time. Where I want to take you next is in the midpoint, where a typical 60-40 portfolio or a 40-60, we'll just call it a good blended, a balanced portfolio, averaging a return of about 5%. How do we help our clients? How do we help you essentially pull yourself up from those average returns of 1.9% up closer to the 5 or even beyond? How do you achieve your goals? How do you avoid mistakes? How do you be willing and have the conviction to act in periods of volatility? Let's keep moving on. One of the ways, and actually I've had clients ask me this question, and my guess is you may have asked yourself the same question, in the midst of the chaos of March, what if we just sold? What if we sat out in cash just for a few weeks, maybe a month or two? Let's just let things settle down a little bit. What would be the impact on my performance and ultimately my financial security? Would it really hurt? So let's take a look at the chart. So what we did here is we looked at a 20-year cycle, 20-year period of time, the last 20 years, excuse me, January 1 of 2000 to December 31 of 19, which, by the way, a period of time that included 2 of those historic declines. If you had invested $10,000 on January 3rd of 2000 in the S&P 500, nearly the peak before the quote tech wreck, and stayed invested, just rode it out, that $10,000 would have grown to what, $32,000. If you had, over the course of those roughly 5,200 trading days, if you had missed just the 10 best days, easy to do, by the way, when you think about the periods of downturn, immediately followed by often a sharp recovery. If you sold on the downs and missed the ups just 10 times out of 5,200, how would it affect you? Well, that $32,000 or roughly 6% rate of return would have fallen to less than 2.5% and $16,000. Meaningful change in your returns over the period. Again, our mission is to help you think through what is the right strategy. How do you build the conviction and confidence to stay the course even in difficult times, to take the smart actions that will meaningfully improve your outcomes. Let's keep rolling.
Thank you, David. It all, is it seems so rational, and you gave us a great perspective in terms of where what we've experienced over the past 2 months, sits from a historical perspective, and it seems so disciplined. But we know that then when you factor in those emotions, the fear and the greed of what a challenge that can become, and so we think that from there is that you may be asking yourself, how do we as an individual or a family or as an organization evaluate that impact? Now what? Where do we sit now as it relates to our financial goals? And so we just use a screenshot here, a screen capture. It's not intended for us to study all the different numbers on this like on some of the other charts, but we think that it's so critically important for you to work, whether you're doing it yourself or you're working with another advisor, is for you to build out a long-term rigorous model. It can be something like we show on the screen, just as an example, or something else that are lots of alternatives in that regard. But we think it's so important for us to think not only about the present and what might be for the next day or week or month, but where does this impact us? How do we think about things? And the ability for us to test multiple different scenarios. So while one column may be our current situation, our current standing, is let's change some variables in another column or in a third column or a fourth column to see how that impacts our overall probability of success, as we say, over the decades. And the other thing is that I think from an industry standpoint that I would encourage you is to look at things from a goals-based perspective, not as much of a historical base. It is important for us to look back and say, how have we done over the past 1 year or 3 years or 5 years or 10 years from a performance standpoint? And that's great, and that's a helpful evaluation. But we also need to pursue that goals-based reporting. Are the actions that I'm taking setting us up for long-term success and greater probability of success in the pursuit of our goals? We refer to it as goals-based reporting here. So where do you start with something like that if you or your advisor haven't already embraced something like that? I would say you start with step one, clearly defining your financial goals. We put on the screen a number of different icons just to represent some of the most common financial goals that we as advisors are talking with individuals and families, specifically if we talk about individuals and families right now, but the same can apply to businesses and to nonprofit organizations as well. And so some of the ones that sort of get us thinking about, what that might look like, and we frequently refer to it as what's a good life look like for you from a financial perspective. And one of the critical roles that our advisors play in our interactions with our clients is talking with and helping them to articulate. You may have a sense in the back of your mind or a vision of what you think that might look like, but how do we actually articulate it and quantify that a bit? And sometimes there needs to be some reconciling, we might say, between differing opinions of priorities as we think about what might be the needs or the wants or the wishes in financial goals. And while that's a great step one, is that for us, we take it to a step two from there, and it's a matter of knowing what you own and why you own it. And so you may own and have some money in bank accounts or in cash reserves. Maybe over the years you've invested in stocks or in mutual funds or exchange traded funds. Maybe it's through a company retirement plan or some savings and earnings that you've done on your own. But why do you own what you own? And what's the long-term purpose of that? And how do they all come together? Of course, in our industry, we have a pie chart that represents those kind of things, but that's the level of intensity in which one needs to look at things and have a clear, this is what we've got, this is why we own it. And it really takes me back to the fundamentals. And in our world, we refer to as a bucketing strategy. And that bucketing strategy is for those assets in which we really have a long-term perspective on. Maybe it's 15 years or greater. For those assets where in that bucket, we can be a bit more aggressive. We understand that, as David showed us on that one chart with the red dots, is that there will be ups and downs, and there will be downs that happen probably on average almost every year of 10% or greater. But those assets that are in this bucket, that's okay. We understand that there will be ups and downs, and maybe we opportunistically need to take advantage of some of those swings that happen naturally. But as we move from the right to the left and our time horizon gets a little bit shorter, of course, we need to moderate the portfolio a little bit, maybe have some different assets in there, maybe have a higher allocation to bonds or to fixed income. And when we get closest to our time horizon that we're actually spending is, of course, that's where our cash reserve or our very short-term bonds fit into the equation for us, that we know the assets are there, and if the investment markets do something or have a repeat of what's happened the past 2 months, that's okay. We weren't spending or selling those stocks in order to use those funds right now. We have other assets as for a different bucket for what our near-term needs might be. So step one, clearly defining your financial goals. Step two, a reminder here of the bucketing strategy of knowing what you own and why you own it, where it fits in the different buckets. And the third step for us would be to understand the results, be able to interpret what we see from these long-term financial models. That's something that some people have the skill to be able to do themselves, and sometimes they look to partner with a professional advisor to say, what do we not see here? What blind spots might we have in our own situation? And how might we trigger something else or pivot in one way or another or change a variable that might make these results look even better as we go forward. But you test those results, and 6 months later and a year later, you revisit, and is something changing in our situation that requires action or doesn't require any action? What you've been doing totally makes sense, and there's no course correction, if you will, required. And so we take back to sort of that screenshot that I had shared with you at the beginning, but we think it's so important, whether it's a tool like this, something you're doing on your own or have developed, or working with another advisor, is that it's got to be there, that multi-decade goals-based reporting tool that allows you to test multiple different scenarios in your own case. It's allowing you to do the math, if you will, and see, when we go through times like this, is there something that needs to happen? So from our standpoint, then, our team of advisors have come together over the past couple of months and have been thinking about what are some of the smart actions. When you think about what has occurred, you may say, well, I've been a victim of what's gone in the investment markets and the economy and shelter at home, or our organization has more demands on it than it's ever had before. And so we all feel some need to take some action, to take some control back, to do something. Well, we look at, and there can be a lot of negative actions. David highlighted some of those in his examples earlier of missing the 10 best days or being captured by the emotions of fear and greed. So let's think about smart actions that one might consider that a year from now, or 3 years, or 5 years from now, you might look back and say, I'm really glad we did that back in 2020. That was a good decision. Those were good financial practices that we put in place. And so over the next 3 slides, we're just going to take a look at that as it relates to different types of people or organizations. One we'd start with is what we think of as accumulators. People whose assets or their earnings exceed what their cash needs may be at this particular point in time. Now, this is not intended to be an all-encompassing list. We just put 6 on here as examples. And while we have had a bit of a recovery in the investment markets, as David highlighted earlier, we don't think that it's too late for people to consider some of the things even that we share on the screen now. And so rebalancing investment accounts strategically. If you previously had a target of having 60% in stocks or 70% in stocks, you may be a little underweight that now. That would be rebalancing the accounts back to your target weight and doing that strategically. There are lots of ways in which you can do that. That's something that our clients that we work with look to us and say, I'm glad you guys are doing that and picking the time in which that makes the most sense. Harvest tax losses is another one that I'll highlight here just for a moment. Harvesting tax losses would be in a taxable account where maybe the asset that you owned is now below what you originally paid for it. You can sell that asset, take the capital loss, put it in your back pocket, as I like to say, and hold that economic value. But we would look and say that you would turn around and reinvest those proceeds, but not to sit in cash, but turn around and reinvest that in something that maybe has an equal or better chance of recovery over the shorter or intermediate term, but you've got that loss from an economic standpoint that you can use to offset gains in the future, whether it be this year or in future years. The other one I'll highlight on this particular page is exploring a Roth IRA conversion. If you have a traditional IRA, it may be worthy of considering, should we migrate or convert that traditional IRA to a Roth IRA? It is a taxable event when that happens, but as a result now, as you get these assets over into a Roth IRA, which grow tax deferred and they come out tax-free in the future. It's a planning opportunity. It's right for some, it's not right for everyone, but we think that in this kind of time period where most asset values have come down over the past couple months, it's a great planning opportunity for people to take a look at. And actually, you're just going to see it on all 3 screens that we're going to look at here. So we move to the second one, which is specifically thinking about business owners and executives and what you might be considering. There are lots of provisions from the 2020 CARES Act that was signed about 4 weeks ago now. And if you haven't taken a look at all those provisions or haven't acted on those, it may not be too late to do that. And we would certainly encourage that. Those could be things like the recently or to be refunded, the Paycheck Protection Program, the PPP loans as it's been referred to, The ability to carry back net operating losses for 18, 19, and 2020 is another provision of that. As well as maybe considering or talking about forbearance on loan payments are all actions in which we have seen businesses and executives taking on behalf of their company in order to protect and preserve the business so that it can come out as equal or stronger than where we entered this particular crisis. You know, we think it's appropriate for you to revisit the various features of your company's retirement plan. There were some changes with the CARES Act, which gave additional, more liberal definitions to some of the ways in which a company plan can be used, and certainly worthy of taking a look at. And actually next week, we're doing a separate talk for a lot of our retirement plan companies and community to talk about, you know, go deeper into each one of those pieces. Depending on your calendar, you might consider funding profit sharing contributions. And if you're a business owner, revisiting or reconsidering your succession plan when company valuations may be a little bit lower here over the next year could be the kind of things from an estate and legacy and succession might be very appropriate for you to consider. And lastly, in terms of some of the smart actions that you might consider as we think about distributors. Distributors can be those folks who are living off the income of their portfolio or taking some of the cash flow off of that. And so, you know, we all know that we've had a change in lifestyle here over the past couple of months. And so maybe go back and reevaluate that income need that you've got. David mentioned a couple times earlier is making sure or ensuring that 3 to 5 years worth of withdrawals are set aside already in cash, money market, fixed income assets so that we don't have to sell stocks at a time in which maybe stocks are lower than where they were not that long ago. We're not forced to sell. We're not practicing the buy high, sell low kind of approach. And also one of the things that was part of the CARES Act that many of you are now aware of, but we want to make sure that all are, is that the CARES Act allowed us to, if you are over 70 and a half or now age 72, is that you actually don't have to take your required minimum distribution this year or in 2020. Those have been suspended for this year. It is another planning opportunity to say, well, where do we get our cash from in order to meet our lifestyle needs? And that's a planning opportunity to say, what's the best place to do that? Where should we accomplish that in light of these ongoing changes? Harvest tax loss, as we mentioned earlier, and then once again, you see that explore that Roth IRA conversion can be really a good planning opportunity for people to think about right now. So when you pull all this together, whether you're doing it yourself or you're working with an advisor that maybe you've worked with for a long time or a fairly short period of time, David highlighted earlier is that, you know, people look to us as a discretionary manager, meaning that we have agreed upon a particular strategy of the investment portfolio, but we also serve as a wealth manager, which means taking a much broader look at people's financial situation than other just investments. And so in our industry, we refer to as a fiduciary advisor, a fiduciary putting your best interests or our client's best interests ahead of ours. So who works with a financial or a fiduciary advisor like that? The way that I've typically have described it is people who are seeking or missing at least two of the three things that you see on the screen right now. And those are time, desire, and resources. For me, it's a matter of time. Is a client of ours might look and say, you know what, I just don't have the time to focus on these sort of things, or I'd rather prioritize my time in other places. It can be my business, it can be my family, it can be volunteer pursuits that I have, it can be traveling or a variety of other kind of things. So time commitment or dedication to it can be one of the reasons why people look to work with a fiduciary advisor. A second is desire. You may just not have the intellectual curiosity and interest in going deep and understanding a lot of the concepts in a way that they feel confident about making financial decisions and moving forward. So desire is something that people need to have as well. And last is resources. We hear from so many of, I don't know what I don't know, or how do I keep perspective on my situation relative to others. We've shown some of those long-term financial models or some of the charts that David had shared earlier. And so the way we view it is people who are missing two or at least two of these three, time, desire, and resources, are really the ones that may be well suited in working with a fiduciary advisor, or at least having a conversation to take a look at their situation and how they've gotten to where they are right now. And are any smart actions that we were just covering something that they should consider. So when you think about all the things that we've shared so far to this point, it may leave you a little bit of, okay, well, what do I do with all this? It may leave you a little bit of, that's a lot of information, a lot of things that we've talked about over the past 39 minutes. Where do we go from here? Or it may leave you with more questions than answers so far from this time, and that's okay. Today we're talking about in strategy and some of the potential smart actions, but we've got an amazing group of participants, but you all have your own unique situation. And so we would try to simplify that and encourage you to think of it in a more simplistic way. And one of the things that I'll draw your attention to is really the circle here, and specifically the 8 financial concerns that go around the perimeter of this blue circle that we use in talking with clients, as well as people that we're meeting for the first time. And we talk about their financial autonomy. It's their pursuit of the financial goals that they have, and at some point getting to a point where they work because they want to, not because they have to. Or maybe a financial concern that you have is around taxes. Am I paying too much? Are there ways in which I might be able to minimize that? What happens if tax rates go higher in the future? You might have financial concerns around your estate and legacy, or you can be subject to paying estate taxes or accomplishing what you want for family or for community cause that you care about. And you can see the 8 concerns that we've identified that go around the perimeter. A lot of what we've talked about today, and a lot of times where our conversations start with people, is around investments. And that's a bit of what we've talked about today, but it ought not to be the only. We can talk about investment strategy, and I refer to that as just one pillar of your overall comprehensive financial strategy. So I'm not sure where it may fit for you, but when you think about an uncommon approach to wealth management, as we refer to it, it needs to take into consideration all these 8 aspects and these different financial concerns that one might have. Now, I'll just point out is that we refer to certain things like risk management or insurance or taxes and estate and legacy. We don't sell insurance. People ask for our advice about that and do a needs analysis. We don't prepare tax returns. We don't draft legal documents. But we need to be well versed in all those different areas to help our clients think through those kind of aspects. And so those are a number of the things that David and I wanted to share with you, as well as on behalf of the team of advisors with McKinley Carter Wealth Services today. And we're happy to take any questions that all of you have thought about as we've gone through today's discussion around investment strategy and potential smart actions that you might consider, whether you would self-identify as an accumulator, if you're one of those business owners and executives, or if in fact you're a distributor. So thank you so much. We look forward to answering the questions as they're coming in, and how we might be able to address that in a general session now or a follow-up in a future time. Okay, we have one question that's come in here. I'll take first, David, and that's around the sessions that we did last week for clients. So we did, in fact, do similar talks. We took a little bit of a different approach, and we got a little bit deeper into some things because these are actually clients who are experiencing things, and we're observing actions that we are considering or taking on behalf of our clients. And so we prioritized that and set that first, but then it was such an outcry of people saying, I think I know somebody who needs to see or hear this information, is that we tailored today's talk to that. We're privileged to be able to use the technology that we have to be able to do this. I'm in my home office, David's at his home. All of our advisors are working remotely over our different locations. But what we see from this is that there is a hunger, there is a demand, there are requests from people who are saying, we need some help, we need to talk about our particular situation. And so we're happy to do that. I know who submitted that particular question, and we'd be happy to answer that as a follow-up today of how we can best meet your particular situation. David, do you have one there?
Yeah, I'll take this one. It's a recommendation on educational savings account that I need to start using in 2 years. So I don't know how large the account is relative to the cost that you will incur in 2 years. Will it be depleted in 2 years, or will it be depleted over the course of 2 to 6 years or beyond? And the second is, it's unclear how much risk is in the portfolio today. let's just play a scenario out here, an ideal scenario, one that was built on many of the topics that Brian discussed. And if you had done the analysis up front and thought through reasonable expectations of what would needed to have been withdrawn over the next 3 to 5 years, tuition in this case, if those dollars were held in fixed income and the balance were in equities, I would leave it alone. I wouldn't do a thing differently. If, however, you were overweight to equities, and you saw the decline that happened between February 19 and March 23rd, and that caused you a great deal of distress. One, you can't handle the risk associated with that, or number two, you don't have enough set aside to cover the first year or two of your child's or your tuition. I would take advantage of the current opportunity. We saw a sharp decline, and then we saw a really sharp recovery, and I would take advantage of what we've seen in the last few weeks, and I would take a little money off the table. As it is, I'm trying to think of the right way to say this. There are so many unknowns about what comes next. All we can do, and there is no playbook, there is no crystal ball. All we can do is stack the odds, the probability of success in favor of our clients. Do what we know statistically should work out well for them, and do that in as many situations as can, and more often than not, it works. So in this case, I think I would, if you were heavy in equities and you don't have enough in fixed income, I would take the recent rally as an opportunity to take a little money off the table.
Thank you, David. I'll take the next one, which comes from a client who might be asking on behalf of them. Comes from a person who submitted. I don't believe they are a client, but they're asking either on behalf of themselves or on someone else who was previously pursuing a moderate investment allocation, a balance of stocks and bonds, as they refer to them in question, 60% stocks, 40% bonds. And when the market dipped here 3 weeks ago, they sold their stock allocation down to 10%. And so now they're 10% stocks and 90% bonds. The question that is posed after they've done that, and now they're feeling a little more confident that maybe that wasn't the right thing to have done, and maybe moving back to that 60% allocation of stocks, should they do that now? Should they make the move and take it as a new opportunity to once again go back and revisit and then say, okay, I understand that there are ups and downs in the market. This was a very emotional reaction that we saw in an incredibly short period of time. David highlighted that some of those 5 worst declines that we had took place over 18 months or 2 years or 3 years or 4 years. This happened in a matter of weeks of what we had. And so we understand why someone would be challenged through that. I would say the answer to that is it really depends on what the math might say. If it's a matter of back to that financial model, if someone can attain and is a better position to meet all their financial goals with a 10% stock allocation, that may be where they ought to be, especially if gripped by the kind of moves that we saw here recently are ones that cause them to question, something as aggressive as a 60% stock allocation. So I would say it's something that I would say would be worthy of going back and revisiting through those 3 steps that I mentioned earlier, and saying let's see what the math does, and if it really makes sense in this particular case to adjust that. We see it all the time, and it's probably one of the most common reasons why people first engage us. Remember, on that circle I referred to investments, is people saying, I have these investments, I've gotten to this particular point, I need some help. I need to think about this a little bit differently so that I don't make big mistakes at this particular point in time in our life, either because the assets have gotten bigger or because they've gotten closer and closer to a point where they need to live off the assets or draw a cash flow from it. And that's when people get the most concerned about making big mistakes.
Brian, I'm going to try to merge 2 questions into one answer, if you'll bear with me for a moment. One question was, I have a portfolio heavy in equities considered dividend aristocrats and have a dividend stream that will support us with my Social Security indefinitely without ever touching the principal. Should I be rethinking this strategy or stay the course? I'm currently down about 17% from my all-time high and have not had any panic attacks yet. A second question that I think I'm going to weave in so I can answer them both together. Are there particular sectors of the equity markets that you expect to do particularly well over the next 6 months to a year? So bear with me a minute. So first of all, for those that are unfamiliar, the Dividend Aristocrats is a collection, a list, if you will, of dividend yielding stocks that have historically, consistently and reliably for decades paid dividends, and in fact, increasing dividends. So interesting, that actually is the basis of one of our equity portfolios. I think I shared earlier that we manage many strategies for clients. We kind of design strategies to meet the needs of clients, but there are two core portfolios. One is a dividend-focused portfolio, and another is the earnings-focused portfolio. So the dividend-focused portfolio, if you in fact are heavily weighted to dividend, the Dividend Aristocrats, so part of this is investment conversation, part of this is planning. If you have a consistently reliable income stream and you are certain that you will not need to touch principal, income streams from Social Security and dividends and pensions, or whatever it happens to be, pull it all together, that's a great place to be, to not have to touch principal. I would just be sure that that is the case for the coming years, 3 to 5 years out. I will say that, of course, there's always the risk that a company could fall out of the Dividend Aristocrats, but they have so much history in that regard. Some are actually even increasing dividends in the midst of this decline. So it's been a great strategy for us, and I suspect it's serving you well too. On the other side of the coin is our earnings-focused portfolio. I'm going to take an opportunity just to spend a minute on that. So our earnings-focused portfolio, we take the S&P 500 and screen it down for dividend or industries that have consistently produced earnings, and then we'll look at companies that are reasonably priced within them. So to answer the question around, is there any place we think will do exceptionally well? I'll just say, generally speaking, we were making changes in our portfolios in the midst of the depths of the declines. Literally, the 17th to the 23rd, we did more trades than we've done in years. There's just so many things we were doing: rebalancing portfolios, tax loss harvesting, improving the quality of accounts. It was one of those once in a decade opportunities to improve, to buy companies that you've always wanted to own but could never get reasonable valuations. I'll give you two examples. Google, well, it's Alphabet actually, is a company that we like. We use it every day. We love the company, but we couldn't justify the valuation. We had an opportunity to buy the stock at a reasonable price, did it. It's in all of our earnings-focused portfolios. Another name, which is actually a retread, was Apple. We had a chance to buy back Apple. We had bought that, gosh, in like October of 2008, in the midst of the last big decline. Bought it, great price, realized phenomenal appreciation, and then eventually, years later, sold it because we didn't believe earnings forecast could justify the valuation. But here had an opportunity to buy it again, so we did. It's important for us to keep in mind, and I just going to button up my answer in this regard, is we're not trying to buy things that we think make sense for the next 20 or 30 days. We're buying things that make sense for the next 5 or 10 years, things that company we want to own, and it's going to work out great for you. So I hope that's a sufficient answer for those two questions.
Thank you, David, for going into to some detail on that. Would you like to take the next one, David, there for a second, in terms of, it asks about, with the trillions of unbudgeted dollars being spent on economies here and abroad, how can this not lead to a major economic downturn in the near future? Might there still be yet another buying opportunity?
Yep. Okay, so that's complex, and so there are so many factors there. One is, what is the effect on corporate America, and what is the effect on governments, and then indirectly on corporations and families. I'm going to go off script here just for a second, so to speak. I don't know how many of you all have, I don't know how you're making good use of your time in the downtime, but a friend of mine gave me a masterclass subscription. And just last night, literally just last night, I was watching a series on economics, and it was Brookman. At any rate, it was just interesting interesting exploration. And the point that he was making is this: if you study the 08 and 09 decline, and I suspect this is going to look a little similar to that, massive stimulus could, and many people believe, lead to hyperinflation and lots of unintended consequences. But he makes a great case why it shouldn't have happened then and it didn't, and speculates that it won't happen this time either. So I'm not sure. I could spend literally 20 or 30 minutes answering the question. I'll just say that I think our earnings outlook is an indication of where we think things are going to go, and we are very optimistic for 2021. We think that there's going to be a pretty healthy recovery. As we look at 2023 and 24, of course, we need to reevaluate those as this unfolds, and portfolios are a living organism where we're modifying month to month, quarter to quarter, tweaking allocations and buying and selling assets as appropriate. Sorry, your question was complex. I took a shot at answering it, but don't hesitate to follow up with us. We'll go deeper offline.
Great. Thank you, David, for taking that. I mentioned earlier in terms of last week, we had our various webinars for clients, and this week on Tuesday, Wednesday, and now today, this morning, we've had the opportunity, as requested, to meet with family and friends. We're currently putting together another series for us to be able to talk with some of those provisions of the CARES Act, as I mentioned earlier, as they specifically relate to businesses. And I suspect as a result of the success and great response that we've had from all of you attending these, is there will be more to come as far as our webinar series. And so we ask you to look for invitations to such things. You can always stay in touch with us via our website, McKinleyCarter.com, as well as the various writings we do on our blog series where we do timely releases of things that are relevant to whether you be an individual or a company or a nonprofit organization. And we put those out there directly through our blog on our website. And something more recently we've put together in terms of a stay-at-home toolkit that you can also find there on our website or with the URL on the bottom of the particular page. I know we're all challenged in a different time, whether you be alone in isolation or with others who are nearby or not, is how do we cope with some such things? And so our toolkit, focuses on a variety of different resources. And if you scroll down through it, you'll see all kinds of things we've put there together that might be a resource for you, family members, and others, colleagues, coworkers during this challenging time. So we want to thank you. And if there are opportunities or if there are needs, or someone was unable to participate in the conversation that we've had today, or would like to learn more about any of the particular topics that we expressed earlier, you see from the various contact methods that we've got on the screen and our representation across our 3 states in which we have offices, as well as I mentioned, serving clients over 34 different states around the United States, are happy to be a source of help. And we so enjoyed the opportunity to be a source for our community and for our family and friends to be able to have this discussion today. So David, thank you for joining me and for your words that you shared as President and Chief Investment Officer. And so on behalf of David McKinley, all of our advisors within McKinley Carter Wealth Services, I'm Brian Gongware. Thank you for joining us today for your investments.
Thank you.